From the 2nd of September this year, IDFC Bank's credit card customers will only have to pay 2% of the total bill amount every month instead of the earlier 5%, meaning the bank has reduced the minimum amount due. Even Axis Bank did this last year in November. So, how does this affect you? If you're a customer, this means that your monthly burden will become smaller. No more living in the fear of attracting those scary penalty charges. So, say you had a credit card bill of 1 lakh rupees. Earlier, you would have to pay at least 5,000 every month. Now, you'll just have to pay 2,000, which means for you, there are lesser chances of being tagged as a defaulter, which in turn affects your credit score. Now, all of this sounds really good, right? So, are banks doing this for you out of the goodness of their hearts? Of course not. My colleague, the Ken reporter Ronak Kumar Gunjan, spoke to two bankers. And they told him that the main reason why banks or lenders are reducing the minimum amount due is because of rising defaults. Now, if you listen to Daybreak regularly, you will remember that I told you about how India has been warming up to the idea of credit. In fact, now it's come to a point where debit card usage has been declining. Online credit card spending in India rose by 20% in the last 1 year to reach more than 1 lakh crore rupees in March 2024. But for banks or lenders, this also means that their associated non performing assets or NPAs have started to become a cause for concern, which is why lowering the limit for defaults will help banks. But for customers like you and I, there is more to it than meets the eye. Welcome to Daybreak, a business podcast from the Ken. I'm your host Nigda Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rahel Philippos and I will come to you with one business story that is worth understanding and worth your time. Today is Thursday, the 8th of August. Do you know who the most loaded set of customers are for credit card issuers? They're called revolvers. I'm serious. For credit card issuers, revolvers are the most valuable customers. Revolvers are basically users who carry a balance from 1 month to another instead of paying the entire due amount. Let me explain. Say you have a credit card with a limit of 50,000 rupees. You use this card to buy a phone worth 30,000. So the remaining amount that you can still use is 20,000 rupees. When your bill is generated for that month, you have to pay the 30,000 in full. And once you do that, your credit limit goes back to the original 50,000. But this is not the only option that your lender or your bank gives you. They tell you that, you know what, you can actually pay the minimum amount instead of the entire 30,000 in one go. We will move the remaining balance to your next billing cycle, carry it forward essentially. So every month you decide to pay the minimum amount instead of the full amount, and it keeps adding to your credit limit. But there is a catch here. When you don't pay your credit card balance in full, your credit card issuer or your bank charges you interest on the remaining balance. This is called revolving credit. The interest can go as high as 42% per annum for users. And that is a crazy amount of money, right? So, revolvers in India contribute the most to the credit issuers or the bank's profits. In fact, around 30% of credit card users actually contribute to most of the income a credit card issuer or a bank makes by charging interests. Issuers have been making obscene amounts of money through revolvers. But my colleague Arundhati had written about this, pointing out how this kind of business was too good to last forever. With increasing financial awareness thanks to the internet and a variety of other lending options, revolvers are slowly moving away from carrying a balance from one month to the next. This obviously affected the lenders or the banks. They were not happy. Now, when you look at how banks are reducing the minimum amount due in this light or in this context, it adds up, right? It boils down to temptation. It's a little bit like the banks telling you, I will give you an offer that you cannot refuse. Stay tuned for more on this. Okay, so let us say that I am an IDFC Bank customer. I use my credit card to buy my dream phone for 1.5 lakh rupees. Earlier, I would have to pay around 7,500 rupees or 5% of the 1.5 lakhs per month as minimum amount due to avoid penalty charges. But now, I just need to pay 3,000 rupees or 2% of the original amount. So I'm like, wow, this is perfect, right? Actually, what I'm not realizing is the interest that I will be paying. Credit card interest rates, like I said earlier, are crazy. They can go up to more than 40%. So instead of paying interest on 1,45,000, which is 1,50,000 minus 7,500, which was the 5% amount, now I will be paying interest on a larger amount, which will be 1,47,000. And that comes from 1,50,000 minus 3,000, which is the new 2%, minimum 2% amount. Now, think of this on a month to month basis. This is a lot of money that I will be paying as interest. There is also another problem or a more obvious consequence of this new change. Both the bankers who spoke to Ronak said that they have noticed that the smaller the EMI, the more likely the borrowers are to keep revolving. So, say, for example, if a borrower has a credit card EMI of 10,000 rupees for a principal of 2 lakh rupees, they can pinch their wallets enough so that they feel more motivated to pay back the entire outstanding amount as quickly as possible. The banker said that they save up more or they borrow from friends and relatives and they are far more likely to pay it back sooner. But with the new reduction, the same credit card EMI comes down to only 4,000 rupees a month, right? So low EMIs do not pinch the borrowers. So they keep revolving without caring to pay the entire amount. And revolving, as we've explained before, leads to higher interest outstanding, which makes the overall deal far more costlier than it originally was. And let us not forget that revolving also affects your credit score, which means that high value loan that you wanted to take, say for your dream home, well, the chances of you getting it will reduce. So maybe the next time your bank tells you about its new customer friendly policy, take that with not a pinch but a nice heaped teaspoon of salt.
Daybreak is produced from the newsroom of the Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription unlocks daily long-form feature stories, newsletters, and podcast extras. To subscribe, head to theken.com and click on the red subscribe button on top of the Ken website. Today's episode was hosted by Snigdha Sharma and edited by Rajiv CM.